This lesson is going to cover reversal patterns in price action. So we've already talked about what support and resistance is, and we've already talked about what market structure is, including Wyckoff theory. So specifically for Wyckoff theory, we look at accumulation and distribution as ranges with very distinct phases, and they typically take, a longer period of time. So you've seen the phases A through E in the accumulation and distribution schematics, and you'll see how price has, a selling climax or a buying climax. It then goes into its structure of consolidation. You then have a spring or an upthrust, all the various events that can happen within a Wyckoff structure that shows the typical rounded top, the nature of which you might see like on Bitcoin very frequently at high time frame macro tops and bottoms. But it doesn't always work like that. Sometimes the market just tops or bottoms in a fast manner. So these are called fast patterns, if you will. A fast pattern is a way so you can identify with high probability that we have topped or bottomed, and so that you're not left waiting for a full Wyckoff distribution or Wyckoff accumulation to occur. The market doesn't always form those patterns. But if you look back at almost every top or bottom that topped or bottomed in a short period of time, it will have one of these four patterns of price action. So you want to see and want to understand what these mean. These mean that there's urgency in the market. So the market is changing direction fast, rather than, let's say, the smart money conducting a campaign to accumulate or distribute. This is one where there's maybe not enough interest, there's not enough liquidity, there's not enough time, and the market just does what it's going to do in a much faster fashion. This is particularly important for anyone trading on low time frames, because if you're day trading, you'll be trading within probably a Wyckoff accumulation or distribution on a high time frame, but that might take 30 days, 60 days. But your daily candles will have a bunch of 1 hour, 15 minute, and 5 minute patterns of exhaustion, double top, double bottom, failure to return, and sweeps and traps. That's where it's particularly important, especially on low time frames. And the other instance where this can be very useful is for shitcoins. If you're trading altcoins, it's not reasonable to expect that an altcoin will do a nice, clean accumulation or distribution on a Wyckoff following the Wyckoff principles. Why? Because the Wyckoff principles are based upon large institutional players wanting to take interest in a position of a coin. You see it on Bitcoin, you see it on Ethereum, and of course you see it in the stock market. But if you're trading Shiba Inus Monkey Coin, there is no institutional smart money that wants to conduct a 30 or 60 day campaign to accumulate all of that coin. I hope that makes sense. That is why, particularly this one, exhaustion, is why you often see exhaustion on shitcoins, because it's essentially like a pump and dump. It's really just an inefficiency. They pump it as hard and high as they can, as fast as they can, but they know that when it's over, it's over. And so by being able to spot these patterns, you can enter positions with more confidence. So let's cover the four general patterns of behavior. First one is exhaustion. This just means that the movement after the final impulse completely reverses. So from the trend trading lessons that if you have an impulse up, and it comes down to, let's say, 50% or even the 61.8% retracement, that's okay, that's still trend and that can go higher. But if you do an impulse move and it comes back all the way down, that is a topping pattern. So that's the simplest, the most basic exhaustion pattern. And it happens the exact same at the top as it does at the bottom. What do you want to look out for there? You want to look out for price retracing all the way back to where it came from. Let's say at least 80%, if not the full 100%. Second one is a double top or double bottom. These are very common in all assets, but in crypto especially, you see a lot of double tops and double bottoms. This just means that the movement for the second test, so right up until the second top or the second bottom, this looks still like a trend. So you need to be very much on your toes and watching out for this. And it fails to reach a clean new high. This is important to note. It might come up ever so slightly below. It might go ever so slightly above. It's still considered a double top. Don't be hung up expecting it to have to hit exactly the same point on resistance or support. Double top, double bottom. Basically cannot make a new high and then reverses. Third, we have failure to return. These are extremely common and probably the most difficult for traders to master. In a simple sense, you see it as a complacency bounce or a complacency shoulder, where we have a strong impulse move, we retrace back, and then we put in a lower high. But by the time it breaks below here, by the time it breaks below this level, traders feel like the move is gone. And what they struggle with is identifying this shoulder and finding ways to get short on that shoulder. Or this shoulder and finding ways to get long. Because what they're expecting is either a double or the next one, which is a sweep. So when it's here, they don't get short because they're waiting for the sweep. Sweep never comes. By the time it eventually breaks down to here, A bad trader will then eventually get short and get stopped out on the next bounce. Or a good trader will realize, okay, a move's gone and on to the next one. But the best traders who have real edge find entry techniques and signals to get in on those shoulders. So that's fail to return. Fail to return just means the movement after the first impulse fails to reach, hence the name, fails to reach the previous high or low before the reversal. Final one, which is probably my favorite. You hear me talk about it all the time, and very, very common in crypto because crypto is a very leverage-driven and trader-driven market. It is the sweep or trap pattern, also known as a bear trap or a bull trap. Many, many names you can say, also known as a deviation. You can call it whatever you want. The principle is the same. The movement that is responsible for reaching a new high or low just ever so slightly exceeds the previous one before reversing. This is important. And I mentioned this a few times in trading analysis. The way you know if it's a sweep or a trap, one, of course, is that it reverses back inside the previous resistance or support. And two, it has less than 20% of an extension beyond the previous move, meaning you get the fib tool from the bottom of the impulse to the top of the impulse, and you draw the fib tool across that, and then you put the 0.2 and 1.2 and find where the 20% mark is. If it falls anywhere within that and back inside, that's a valid sweep, a valid trap. If it goes beyond that, let's say it goes 30% or 40% above the high and then pulls back inside, that is more likely to put in a higher low and actually continue trending. A sweep or a trap, it should go above the high or below the low because it's doing the sweep or the trap, but it should find resistance or support very soon after that because the move was only to grab the stop losses of the people who had their stops at support and at resistance. And so, in summary of that, you have those 4 patterns. You can find those across all time frames, and that's what's most useful about them. Because of the fractal nature of the market, we can see them on every time frame, in every type of setup, and every different market phase. So there's something you should commit to memory, print them off, keep them on your computer, develop your pattern recognition. You do not have to trade every one of these, but you should be going along as you're charting and marking them on each time frame and seeing which one appears most often on whichever coin I'm watching. Maybe you're watching Bitcoin, maybe you're watching Ethereum, maybe you're watching alts. You should always be watching multiple coins, but the good trader, the profitable trader, the future pro trader will be tracking these and saying, I've noticed that, of the last 50 swing highs and swing lows on Litecoin on a 4-hour chart, there has only been 3 fail to returns out of 50. However, in those same reversals, there were 17 sweeps and traps, and there were 12 doubles, and there were X number of exhaustion. Then you could say, okay, well then I compare that to Bitcoin. And you say, well, actually on Bitcoin, fail to return has a much higher instance of actually occurring because maybe there was 12 out of 50 instead of 3 out of 50. That is where you start to develop some edge. The average trader just sees the schematic and thinks, oh, well, Michael says every time there's one of these patterns, then I can just go short or go long. No, you add context to it. And what we do in the next lesson and the lessons to follow after that is drill down into this and show how you can add confluence to it using volume, using positioning and flow, which we've talked about previously, and taking this off of just being a schematic and bringing it into the real trading world and showing you how you can build it into a system to actually generate edge. So let's get right into the next lesson.